Welcome to Breaking In. I talk with regular people about how they broke into Wall Street. Today, Greg Magadini shares how he went from amateur boxer and community college to retired at 29.
This is how to break into crypto. Thinking you're trying to break into Wall Street. It's my honor to have Greg Magadini, CEO of Genesis Volatility.
I was an amateur boxer. I knew I liked risk, and I discovered financial risk and economics when the 2008 economic collapse was happening. When I was in junior college, I discovered options, and I spent a lot of time studying options. Every single time that I've got training jobs or met with investment professionals, knowing derivatives has been an edge. I blew the interview. No, it didn't go well at all. I was a nervous wreck. Then I decided to make a second opportunity for myself. 2 days later, I booked a flight to New York, unannounced, showed up, and knocked on his door, and I said, hey, listen, man, I screwed up that call we had, but I think that I'm a good fit, and you should give me a second interview. I got that internship at S&P Capital, and I was super happy. Coming out of college, I got a prop trading job offer out of Chopper Trading. That was the dream job. You talk to traders who happen to get lucky every single time. You can make money consistently. You can, do well in the markets that you're trading and out-trade the market. I'm in the crypto volatility space now. Crypto volatility is like 100% realized and implied, whereas equity volatility is like 17%. And when you're spread trading for treasuries, you're spreading $2 million against each other to squeeze out $300. Like a regular person, what sets people apart is the amount of hours that you put in. No one's born understanding how implied volatility dynamics or the treasury yield curve moves. Trading is so competitive. If you are not obsessed with trading, I don't know how you can make it in the long run. I discovered Bitcoin in 2012 with Linda Xie at UC San Diego. We downloaded Tor, we went on the dark web, and this was Bitcoin at $7. I was a naysayer. Late 2013, Bitcoin was around $200 and making new highs. From a technical analysis perspective, there's no way I don't see this thing going higher. And that's when I first flipped to the other side and bought Bitcoin, and then became more fascinated with the value proposition of Bitcoin. I sold 100% of my Bitcoin for Ethereum, and I didn't understand why everyone else in the world wasn't doing the same thing. Yeah, I'm pretty much an Ethereum Maxi. Not that I don't like Bitcoin or other altcoins. It's not even close. Ethereum has all the development power behind it, the whole DeFi ecosystem behind it, the whole NFT ecosystem behind it, the whole ICO ecosystem behind it. Every headline-grabbing event that ever happened in crypto, besides Mt. Gox getting hacked, is done on Ethereum. Ethereum is here to stay, and it's going to be very hard to dethrone Ethereum from the smart contract platform. I'm firmly convinced that Ethereum market cap will flip Bitcoin market cap at some point in the future. I could have traded it better because the smart move was buy it, walk away, and don't do anything.
How old were you when you retired for the first time?
I was 29. I was pretty excited. Even though I felt financially stable, I had this weird anxiety that I was missing out on something. That next morning, my co-founder called me, working for this on-chain data analytics company.
Talk to me about coming out of retirement for Genesis Volatility.
We were looking at Ethereum on-chain data. Every transaction that's occurred since the Genesis block, you could see when a big whale is sending money to some ICO contract or holding some new tokens that no one started holding yet. Because I was trading crypto, having access to this data was interesting. I discovered Derebit, crypto options exchange out of the Netherlands. My main passion is options first, crypto second. When I discovered crypto options, I wanted to learn everything about this exchange. You could see when people trade Ethereum options, they have to send Ether to their Derebit account. Overlaying these derivatives on a new asset class that people are discovering as they go was super interesting.
How did that become Genesis Volatility?
We've been building Genesis Volatility for 2 years now. We knew that there was demand for crypto options. I was passionate about that to start with. This was perfect for me. Waiting is a skill that's very well rewarded in trading. But when you're building a business, it's the opposite. Your business is either growing or it's dying. I can't do this business without having the trading background. I have to have the trader's mindset for the tools that I'm building. As a trader, this is how I would want to look at it. These are the data points that I think are interesting. Paradigm has this great tool set that allows market makers and whales to start trading options together in a cost-effective way without incurring a lot of slippage in the market. We struck a partnership early on, and it validated our vision that these tools were needed as the market grows, which is the bet that we're making. Then we become the de facto platform.
What's the best way to build wealth?
For real estate, the forgiveness for error is pretty big. The cards are stacked in your favor for being profitable. Trading feels like feast or famine. You need to balance that out with another steady stream of income unless you can budget every peak and valley perfectly. Building my own company, that's been the ultimate wealth creator.
Welcome, Greg.
Thanks for having me, Emmy. Happy to be here.
Thanks for being here. Talk to me about the moment that you and I first met.
This was back in undergrad for me. I was a senior in UCSD in college studying economics and minoring in accounting. My passion had been, at the time, about 4 years now, trading. I had learned about Emmy as an alumni who was in the investing industry. We had a meet and greet cocktail party for the students and the alumni who were in the industry already. I studied up on you, Emmy. I was definitely nervous, but I went up to you and I started saying, I know that you work over here. I know that you've done this in the past. And I have this idea about this Japanese yen trade, which has been one of my biggest obsessions for over a decade now. What do you think about it? And give me some of your feedback. And that's how we started the conversation and got to know each other.
Then I said, if you want to continue this conversation, why don't we set up a student investment club?
Yeah, that was interesting. You and I started an investment club for students who are interested in taking a deeper dive in how to do fundamental analysis, how to structure investments. I was involved with some other finance clubs at UCSD, and those were places that we were sourcing students to come to our club.
Talk about how you came to be at UCSD.
We went to junior college. It's a two-part story. The first part is I didn't know what I wanted to do out of high school. I was an amateur boxer at the time. I was doing competitive boxing. I thought if I'm going to go to school, I'll study some nutrition. That'll help me with my boxing career. I can tackle it from two angles. Then I learned about brain damage, and oh man, I don't know if this is the best path for me going forward. I knew I liked risk. I was always interested in risk. Before boxing, I did skateboarding, and skateboarding was the most risky. And I was like, oh man, if I could find something a little bit less risky, but still risky. And then I discovered financial risk and economics when the 2008 economic collapse was happening. And that's what piqued both desires. One, a lot of risk, but two, nothing that you can damage yourself that you can't come back from. When I discovered economics, I knew that's what I wanted to study. That's what I was passionate about. All clicked. It was one of those things I always knew but didn't discover. That happened while I was at junior college. Once I discovered that path, I changed all my classes, did all the econ prerequisites, and dedicated my life and my learning path to everything about economics and finance and ultimately trading. And so the UC system is a nice path to go to from junior college. If you have this grade point average and you've done these prerequisites, you can get into one of these universities. I transferred from junior college to UC San Diego. That was the academic path. The other financial path to that is that junior college is the cheapest way to go to college. Junior college is almost free, minus some textbook costs and maybe $1,000 a quarter type of student fees, but it's a great way to cut your university bill in half without needing to do anything special. That made a lot of sense.
Your parents weren't able to foot the bill for college?
You ask, my grandparents did have some money put away for college for me. I think it was about $70,000 to go to college. When I went to junior college, I got to keep a lot of that money because the housing market was in distress. I had enough money to make a down payment. I decided to borrow to go to UC San Diego and use the money that I had to make a down payment on some real estate and bought a rental property during the financial crisis.
Cool. That started your interest in real estate then?
Definitely. Real estate is such a good long-term investment. I like to trade stocks and and other liquid assets. It's always hard to be in the mindset of hold forever. But with real estate, to me, it's the ultimate parking spot. It's where my money goes to rest. Owning real estate worked out well with that first investment property. It's always been something I've looked to invest in with the funds that I make elsewhere.
Then you transferred to UCSD and got an internship at a hedge fund. How did you do that?
There's two internships that were good. One I got during junior college. There was a CEO of a biotech company who was looking to start an investment firm. Think of it as a family office. He was looking for someone to trade the markets with his money. That was my first prop trading job. It wasn't an official prop firm, but it was a proprietary basis agreement where he would furnish the capital.
While you were still in junior college, how did you do that?
When I was in junior college, I had discovered options, and I spent a lot of time studying options. He interviewed quite a few people. His idea was to find someone to research penny stocks or small cap stocks and find some opportunities that could go 5x. I explained to him that the option market is the perfect vehicle for this because you can find those asymmetric returns on large cap companies that have some real backing to them. If you get the timing right, you can use option instruments to get the same risk profile that you want. That set me apart from everyone else that he had been talking to, is the understanding of derivatives. That's been a huge theme throughout my career. Every single time that I've got training jobs or met with investment professionals, knowing derivatives has been an edge.
Then your second internship, did that have to do with reading a book?
Yeah, this is one of my favorite stories in my life. I was very happy about this. So I read One Good Trade by Mike Bellafiore. He co-founded S&B Capital, which is a day trading prop firm out of Manhattan. He wrote a book that depicts how he teaches his traders at his prop fund to trade and what the most successful traders do. He has the mindset of there's no secret trade. It's like a sport. The secret to shooting three-pointers is taking a lot of shots and practicing your three-pointer skills. It's the same thing with trading. He views the layups or setups for potential profitable trades. It's your job as a trader to study the setups that work for you, to know all the variations that they can take, and to trade with a risk profile or risk management system that works well for you with those setups. Once I read that book, it clicked for me. That was probably one of my favorite trading books at the time. And he happened to have his email at the back of the book. I shot him an email and I said, "Hey, Mike, I read your book. I'm out of UC San Diego. Trading is my passion. I'd love to get to know you and potentially intern over at S&B for a summer." He got back to me. I was surprised and I was very happy. We went back and forth on email a little bit, and he decided to give me a phone interview in order to see if I was a good fit for this internship. And I blew the interview. No, it didn't go well at all. I was a nervous wreck. I was well prepared, but my execution was poor. It was gone. Then I decided to make a second opportunity for myself. 2 days later, I booked a flight to New York, unannounced, showed up, and knocked on his door, and I said, "Hey, listen, man, I screwed up that phone call we had, but I think that I'm a good fit, and you should give me a second interview." And he said, "All right, cool. Show me what you got." But that time I did land it. I got that internship at S&B Capital, and I was super happy to be over there.
My boss, a world-renowned hedge fund manager, what did he tell you?
Yeah, he said, no one becomes a prop trader without 20 years experience in the professional markets.
No one would hire you straight out of college.
Yep, pretty much.
Then you got an offer at a top-tier Wall Street firm coming out of college.
Yeah, I had interviewed with quite a few big banks. Deutsche Bank was the one. That was a sales and trading role, which is different from a proprietary trading role, and I appreciated getting that opportunity. Coming out of college, I got a prop trading job offer out of Chopper Trading. What they do is spread cash treasuries versus futures treasuries. So prop trading the treasury basis, essentially. That was the real dream job.
A prop trading firm around treasuries and cash. What was it like trading treasuries?
Proprietary trading is the most you eat what you kill type of job in the street. You don't have clients. You use company money to beat the market. And if you do that, then you get to eat. And if you don't, then you don't get to eat. And that's one of those jobs that's to me is fascinating. The academics in your econ classes will tell you that job's impossible and that the markets are too efficient and that anyone who outperforms the market happened to roll 6 dice rolls multiple times in a row, but that's variance and they got lucky. Then you talk to traders who happen to get lucky every single time, and they seem to make it fine. I think the mental barrier of those messages that you get in academic economic circles was something that I had to get over. You can make money consistently, you can do well in the markets that you're trading and out-trade the market. I'm in the crypto volatility space now. Crypto volatility is 100% realized and implied, whereas equity volatility is like 17%. And then to your point, treasury volatility, if you're looking at 10-year notes or 30-year bonds, it's between 2 to 5% vol. Vol is compressed and these things don't move that much. And then when you're spreading them, you're not trading outright directional volatility, you're trading relative volatility with 2 highly correlated instruments. And when you're spread trading treasuries, you are trading $1 million cash by 10 futures on the other side, which is about $1 million. You're spreading $2 million against each other to squeeze out $300. So you got to use a ton of leverage in order to make scalps worth it.
What allowed you to break into a prop trading firm, into UCSD, into this hedge fund? You started a family office when you were still at community college. Is it that you're an incredible genius?
I'm a regular person. People's intelligence goes around the mean and everyone's about the same. What sets people apart is the amount of hours that you put in. No one's born understanding how implied volatility dynamics or the treasury yield curve moves. If you take the time and read up and learn how to price these things or how to look at these markets, then it's easier to conceptualize this in computer programming. If you spend 10 years coding computers, you might not be the smartest person in the world, but you know how to manipulate this machine that essentially makes you the smartest person in the world.
What allowed you to let people see your potential, give you a chance?
The big difference is how many hours of time that you put in. The only way you can put that much time without hating your life is to be passionate about it. Trading is so competitive. If you are not obsessed with trading, I don't know how you can make it in the long run because you have to keep learning and it's never ending. I think that's the main difference.
Obsessive focus on one thing. I remember at UCSD, you were super focused on time management. What would you advise people that are starting out about time management?
There's a great book on time management by David Allen. He taught me a lot of tricks. The big thing was prioritizing what I wanted to do most. Pass, no pass was the closest I ever got to not passing a class, but otherwise my grades were important. I wanted to graduate with an A- average. I was the goal. And then getting a job. I did a lot of interviews, applied to a lot of different firms to get the job that I got at Chopper Trading. It took 5 or 6 months of applying to over 100 places in unique ways, not going to the company portal and typing your name.
Let's jump back into your journey. Time management is key, not feeling discouraged and knowing that you may have to apply to 100 to get the one that you want.
I was stressful. I know a lot of college students are in that position. That's not a place I want to go back to. If you feel discouraged looking for jobs, that's normal. You just need one to say yes. Keep that in mind. And trading is always top of mind. That's effortless. It's a lot harder for me to have fun than it is to think about trading or markets. It's a lot more work to figure out what do I want to go do for a fun activity on a Friday night with my friends. But trading and thinking about the markets is effortless.
Then your company gets bought. What happened?
Chopper Trading was bought by Derebit, which is another big prop firm in Chicago. It's one of the biggest and well-respected prop firms. It was, at the time, one of the only prop firms in the crypto markets. Today, they're still one of the biggest players in the crypto markets. A lot of the DRW alumni are all in crypto, doing cool projects.
Did that get you into crypto?
I was already in crypto at the time. I discovered Bitcoin in 2012 with Linda Xie at UC San Diego. We decided to do a research paper together and we're trying to figure out what we wanted to study. We started with the gold standard. That happened 40 years ago, and I had heard of Bitcoin before, and I told Linda, and she was totally into the idea. That's how we first discovered Bitcoin together.
What did your paper conclude in 2012?
I think everyone who's in crypto now had the same path. I was a naysayer. We downloaded Tor, we went on the dark web, and this was Bitcoin at $7. And I thought, Bitcoin seems to be used for nefarious things. The government will shut it down. Or if they don't, it's such a small float that it's probably manipulable. I decided to stay out of it. And it wasn't until late 2013, Bitcoin was around $200 and making new highs. From a technical analysis perspective, there's no way I don't see this thing going higher. And that's when I first flipped to the other side and bought Bitcoin, and then became more fascinated with the value proposition of Bitcoin and started deconstructing why the value proposition, despite being an intangible asset, made a lot of sense.
What got you involved in Ethereum?
Linda first told me about Ethereum. She was working at Coinbase at the time, and a lot of her peers were fascinated with Ethereum. And before Ethereum, Bitcoin had these projects for smart contracts called colored coins. And it was this concept that you could do more beyond money in the digital asset space. And Ethereum came out, and they had the smart contracts. That's when I first learned about Ethereum. I didn't pull the trigger on the Ethereum ICO. I did some other stupid ICO called Mastercoin that didn't do anything. Lost money on the ICO of 2014. That's unbelievable to me. That was the one that I invested in. When Ethereum started trading and people could start buying it on exchanges, DRW had a position in Ethereum they wanted to get rid of. And they offered it to other traders, do you want to buy some Ethereum? One of my friends who's into crypto reignited my interest. At that point, I decided that Ethereum made so much more sense. I sold 100% of my Bitcoin for Ethereum, and I didn't understand why everyone else in the world wasn't doing the same thing.
You've been an Ethereum bull since then.
Yeah, I'm pretty much an Ethereum Maxi. Not that I don't like Bitcoin or other altcoins. It's not even close. Ethereum has all the development power behind it, the whole DeFi ecosystem behind it, the whole NFT ecosystem behind it, the whole ICO ecosystem behind it. Every headline grabbing event that ever happened in crypto, besides like Mt. Gox getting hacked, is done on Ethereum. I don't see how that changes. My lesson I learned from Bitcoin was first mover network advantages are very valuable, and don't underestimate those. Because I couldn't believe that Ethereum wasn't worth more than Bitcoin 2 weeks after I made my moves. It makes me think that network advantages and first mover advantages cement Ethereum as well in that same position. Because Ethereum has the network advantages of this developer ecosystem, network advantages of being a base layer infrastructure for all these tokens built on it. It has a first mover advantage for smart contracts, dApps. So even though EOS or Tron might have faster throughput, they're not Ethereum because no one's moving their whole development infrastructure from Ethereum to Tron. Ethereum is here to stay, and it's going to be very hard to dethrone Ethereum from the smart contract platform. I'm firmly convinced that Ethereum market cap will flip Bitcoin market cap at some point in the future.
You shared this information with friends who are also my mentees. I remember them saying, I put in a couple hundred, but Greg put in big money. You bet big because you were sure, and you bet big early.
In retrospect, I could have traded it better because the smart move was buy it, walk away, and don't do anything. My mindset, the trader's mindset, I went as big as I could possibly go, that if things went wrong, I wouldn't lose my house or lose all my savings or my job or anything like that. I went almost irresponsibly big, but not quite irresponsibly. But at that point, when Ethereum had its first move higher to call it $50, which now seems like pennies, but at the time it was a huge percentage move, 500% from my entry price, a little over that.
Talk about that from the trader's perspective, then tell me what you did with the money.
My scaling mentality was when I have this certain dollar amount of crypto, I want to half it. As it rallies some more and it gets back to that dollar amount, I want to half it again. And I want to keep selling 50% in perpetuity forever. And that was my scaling out strategy. And I was happy at the time, and I'm still happy. I'm still very grateful and thankful. But in retrospect, it's hard to not kick yourself when it would have been the best thing to do to put it away and wait 7 years and then come back to it then. Every time I pulled money out, I put it in real estate. Real estate has thousands of years of history. Land is limited, at least horizontal land. If vertical land is infinite, horizontal land is definitely finite. To me, that made a lot of sense with good rents on apartment properties, multi-units. That's what I did with the money that I pulled out of crypto.
How old were you when you retired for the first time?
I was 29. I was pretty excited. Cool, I quit my job. I was still trading the markets, trading my book, doing that full time. That's what I wanted to do, is trade my own book and not work for anyone.
Have your real estate rents pay for your lifestyle?
Real estate rent is safe. You can count on it to a certain extent and not worry too much about making it month to month. That covers base expenses. And if I make more money in trading, I buy more real estate and then increase that base level. Even though I felt financially stable, I had this weird anxiety that I was missing out on something. Like I had blinders on and I could see what's directly in front of me, but there's this bigger world I was missing. I couldn't escape that feeling. What is it that I'm supposed to do? Can the universe send me a sign? I'm missing something, but I don't know what it is. That next morning, my co-founder called me, working for this on-chain data analytics company called FRST.
This is how to break into crypto. Thinking you're trying to break into Wall Street. Talk to me about coming out of retirement for Genesis Volatility.
They said, we need a trader. Are you interested in doing some part-time consulting for us? Because we have all this on-chain data and we're trying to parse it into trading signals, but no one has trading experience. Would you be interested in working on a part-time basis, consulting for trading signals? It hit me in the face right there that I should look at some of this data on chain and work with these guys at FRST.
Cool. And what is on-chain data and what opportunity you saw when you started to look for signals?
We were looking at Ethereum on-chain data, every transaction that's occurred since the Genesis block. You could look at every wallet on Ethereum and see what they're holding and find every whale and see where they're moving their money. There's a lot of cool, interesting things that you can notice on chain. You can look at the flows going to exchanges or out of exchanges. You could see when a big whale is sending money to some ICO contract or holding some new tokens that no one started holding yet. You could see the amount of distinct wallets purchasing a specific token. Wow, this has a bigger user base than this other token that might have a higher price, but it has 3 people owning all the float. There's a lot of these things that lived on chain that you wouldn't be able to see. It's like looking at your brokerage account and knowing what every customer has in their holdings. The second layer of transparency was fascinating. Because I was trading crypto, having access to this data was interesting for my own trading, because it gave me a level of insight that I wouldn't have had. I discovered Derebit, crypto options, exchange out of the Netherlands. My main passion is options first, crypto second. When I discovered crypto options, I wanted to learn everything about this exchange. I was looking at the flows going to and from the exchange. Because Derebit is crypto options, but the accounts are funded with coin themselves. You could see when people trade Ethereum options, they have to send Ether to their Derebit account. You could see how many distinct wallets are sending Ether to the Derebit master contract, and where that master contract is, how many flows are going into it, what's the total amount of flows, and how many flows are going out. I started studying this exchange from both a volatility perspective and a on-chain perspective. At the time, I was building tools in Excel VBA for volatility trading. I was monitoring that market and seeing how people were pricing the options market, and using that as a tangential signal on top of the on-chain signals. Monitoring the vol market as well as the on-chain data was super fascinating to me. One of the big things with on-chain data, at least at the time, was that people were interested in it, but how to use this data was still a big question. We had a bunch of prop firms in Chicago as clients to this firm, FRST, and we would start with talking about on-chain data.
How did that become Genesis Volatility?
Maybe I was an influence, but we'd always end up talking about derivatives data. Derivatives data is a data set that people know already. People know how to price derivatives and trade those, overlaying these derivatives on a new asset class that people are discovering as they go was super interesting. That's where a lot of the demand was coming from, these prop shops. Eventually, the business model of FRST didn't work out, and they ended up closing shop. We decided to build something around the opportunity of the crypto option space. We knew that there was demand for crypto options. I was passionate about that to start with. This was perfect for me. I was the guy to at least help build it. And my co-founder was super supportive and he wanted to do it as well. Together, me, him, and another guy from FRST launched Genesis Volatility. The third guy became our CTO. My co-founder became the president and I became the CEO. Together, we built out our first beta product. We held a closed beta where we opened a Twitter up and reached out to people and see if they wanted to try our closed beta and let us know what they thought about the app and our features around the vol space and things like that. It got a lot of good reception. We were happy and we opened it up to the world and put up a paywall and started a business around the volatility analytics we saw in the crypto option space.
How did you go from prop trading to business strategy and partnerships?
We've been building Genesis Volatility for 2 years now. One of the differences between the two stresses from trading versus building a business is that in trading, one of the hardest things is doing nothing. Monitoring the markets, being patient, not forcing an opportunity that isn't there just because you're bored. Waiting is a skill that's very well rewarded in trading. But when you're building a business, it's the opposite. Your business is either growing or it's dying. It's never standing still. But if you're not running at full speed all the time, it's dying relative to everything else that's happening in the market. This pressure of you need to always be doing something is the biggest difference between trading and running your business. I can't do this business without having the trading background because I have to have the trader's mindset for the tools that I'm building. Because as a trader, this is how I would want to look at it. These are the data points that I think are interesting. These are the data points that people use to price volatility and see how the volatility surface is moving and things like that. To run this successfully, it ends up being a lot more about reaching out to people, starting business relationships, finding ways to collaborate with various projects. One of our biggest initial partnerships, we had two. One that didn't work out, which was surprising because we put a lot of work into it, was with an index provider to start doing volatility indexes. We were a little disappointed about that. But then we had another partnership that worked out well. It's with Paradigm, which does RFQ block trading on Derebit. Their client base needed some analytics to help them block trade successfully. Paradigm has this great tool set that allows market makers and the whales to start trading options together in a cost-effective way without incurring a lot of slippage in the market. We reached out to them and told them, hey, I'd love to demo what we've been working on and see if there's some way that we could work together. But the Paradigm team was great from the start and they wanted to work with us. We struck a partnership early on and it validated our vision that these tools were needed and there's a lot of work to be done in the crypto option space from a content perspective and from a data perspective that was missing in the market. The question I get a lot is, if you have this data, why don't you trade it yourself instead of selling it? It's true that in the short run, trading these markets, especially as they're inefficient, is going to be more profitable, both from the side that there's a lot of inefficiencies to be had, and from the other side where selling data is not very profitable in the beginning when you have a small client base. In the longer run, the payment profile's inverse because the market becomes more efficient and the edge that exists in these markets right now gets squeezed out because there's a lot of players all trying to do the same thing and cannibalize each other, and the share of potential market profits diminishes. On the flip side, being early to market with a product, although the market's pretty small and the revenue is not necessarily enough to build the most profitable business out of the gate, because the market's small, you have this edge in timing that allows you to be the first to capture network effects and build a brand in this market. As the market grows, which is the bet that we're making, then we become the de facto platform and our subscription revenue increases dramatically because our customer base has increased so much. And so we become more profitable as the market grows, as opposed to being squeezed out by competition for the inefficiencies that everyone's trying to chase.
Market becomes more efficient, then they need you for every single tick.
We felt like there's no one competing in crypto options data. There was Skew at the time, and Skew is, I guess, the OG first mover, but they weren't 100% into options. They covered some options and they covered some futures and they covered some macro metrics and things like that, where we wanted to do options, but at the deepest level possible. New options features, new ways to look at options, a whole historical data tab that was missing. How did these things trade in the past, and how did these quotes move in different markets? That was missing from the market. Our first product design idea was getting historical data and realized volatility tools out there in the market. Those two were missing.
You've made money in your own company equity. You've done real estate, long-term investing, options investing, as well as owning your own equity. What's the best way to build wealth?
I'll say the pros and cons of each one. For real estate, the forgiveness for error is pretty big. The cards are stacked in your favor for being profitable. That works out nicely. You get tax breaks from mortgage interest deductions. You can deduct depreciation against your investment property, things like that. There's a lot of incentives built into the system to make it profitable to own real estate here in the United States. And interest rates are low and they're fixed for 30 years, which is something that most countries don't get. We get that from Fannie Mae and Freddie Mac subsidizing our mortgage markets. That makes it hard to screw up a real estate investment in the long term. That's a nice forgiving market. But the flip side is going to be a get rich slow method. You only get a fully paid off house at the end of 30 years, and income of a fully paid off house is not necessarily enough to live off of. You might need a couple to make it work. The trading side is interesting as well. The trading is a lot more volatile than real estate income. In my experience, trading feels like feast or famine. I have periods where trading is amazing. I'm making a good chunk of money. And then there's other dry spell periods where it seems like everything I do doesn't seem to work, or that the market has shifted on me and I'm trying to figure out a strategy that's going to adapt to it and become profitable again. And that feast or famine, you need to balance that out with another steady stream of income, unless you can budget every peak and valley perfectly. There's a lot of variance to trading, but when it's good, that's how you're going to make big money in a short amount of time. And that's the draw to trading. Another draw to trading from high frequency or diverse strategy perspective, if you're a firm and you have multiple strategies that go in different directions, that cancels each other out from a variance perspective, and you can isolate positive expected value from many strategies that are positive EV but going different directions. Trading is scalable. That's what's interesting. If you have a strategy that works making a good return on a little bit of capital, most of the time you can add capital and magnify your return in an absolute dollar basis, even though the percentage is the same, and that becomes profitable. A small winning strategy, that's the hard thing to discover. The easy part is finding capital to be allocated to it. You think of a hedge fund such as Renaissance Technologies has been consistently profitable, and they're so profitable that they kicked out all their investors. The only way you can be an investor in Renaissance Tech is by being an employee. The scalability of the capital, it can't take infinity capital, but it can take enough capital that a few strategies consistently produce can pay off all their employees, and they can run the whole firm on their own money. That's what's cool about trading. Finally, in my experience, building my own company, that's been the ultimate wealth creator. What's interesting about building your own company is that your skill set becomes a lot wider. You need to do a lot of things when you're in startup mode that you don't normally do. You got to do the legal contracts, you got to take care of payroll, you got to figure out people's benefits, you got to be on sales calls all the time, you got to develop the product. In this information business, you have to learn the skills to know what you're talking about, to be able to sell. If I never had options experience, there's no way. I need to know how to look at these markets. I need to know what's relevant and how to talk about this data. Building that skill set definitely takes at least a decade to get it good. Now, building the company around the skill set becomes doable.
Incredible. Greg, thank you so much for coming. I appreciate your time here. Hit subscribe below if you want to see more talks on how to break into Wall Street and real wealth. Thank you.
Thanks for having me.